So what should you know before practicing the infinite banking concept? So the infinite banking concept, or becoming your own banker, is a great concept. Really teaches one how to use a high cash value life insurance policy, specifically a dividend paying whole life insurance policy, as a financing tool. Once a dollar passes through a policy, there's no lost opportunity cost. I can use the money indefinitely, whether that's to pay off debt, invest in real estate, in business, whatever it might be. Great concept. It works beautifully. But what we found over the years of just being in business and working with individuals, whether they own businesses or they are just an employee, an average employee for another company or something like that, is often one is exposed to the concept, whether they read Nelson's book, they find out about it online, they talk to someone who specializes in the concept, and they're presented with a policy and they look at it and say, okay, I get that I can practice the concept with this, but it takes forever for me to get my money back, meaning I'm paying in, call it $10K a year. It takes 7 years or up to 10 years just to break even. And then it's with some company that I haven't heard of. How do I know they're a solid company? Are they actually going to produce what this projection says they will produce? And the thing is, that has been, in my opinion, the one thing that has stopped a lot of people from moving forward with the concept, because they're putting all this money into a cash value life insurance policy, and they have somewhere between 50 and 60% of their payment in the first year. They're losing money paying for the huge insurance expense, the death benefit up front. So really, when it comes to practicing IBC, what we educate everyone on before that, for someone that says, hey, I want to practice this concept, how do I make sure it's set up right? Well, what we will teach you how to do, whether you're looking for a policy or in the industry trying to teach your clients this, is this simple: how to maximize the cash value of a life insurance policy first and foremost. Because if that cash value is maximized, what that does for you is, one, gives you more money in a cash value life insurance policy, compounding for you. You've got more money from start to finish, breaking even much earlier, typically between years 3 and 5 instead of 7 and 10. Copying what big institutions and banks do, by the way. So that's the first thing: design the policy for maximum cash value and flexibility. And then 2, company selection. A lot of insurance companies out there. How do I make sure I'm set up with a company that has actually delivered, not just projected one thing and then under-delivered? So we're going to walk through those 2 items here. So again, we do this before practicing IBC. So we're assuming we understand the concept. We want a policy, but we want to make sure it's set up right so I don't have buyer's remorse down the road. We run into that all the time. Someone takes out a policy and says, wait a minute, if I would have known I could have had 30% more in the first year of my money, what I paid into it, I would have went with this option. Why was I not shown this? You see it all the time. So when we set up a policy, this is going to teach you right here how to maximize the cash value of your dollar. Your money can go towards one of 2 areas: the insurance premium or the PUA rider. The insurance premium, let's say you're paying $1,000 per year there, or $100,000, doesn't matter. In respect to your cash value, dollars that go into the insurance premium typically produce little to zero cash value in the first and second year. The reason why is that the premium dollars buy us a death benefit first and foremost. So when I take out a life insurance policy, your money can go toward the insurance premium or directly into the PUA component. The insurance premium, which I'll often refer to as the initial insurance expense as well, the company overcharges me as the policyholder for the death benefit upfront in the first and second year. And it's after that point in time, as I hit year 3, now you will begin to see that minimum premium show up in cash and start to yield dividends and interest. So that's the first area. The second area is my PUA component. I'll refer to this as a cash dump-in. What we are doing here is accelerating the cash value of a life insurance policy. Dollars that go into the PUA component show up in cash value. It's going to be anywhere from, right off the bat, 97 to 100% of my payment in cash value. That's money you can access right away. That's money that begins to yield the guarantees right away. That's money that begins yielding dividends sooner. This is the key, pardon my poor handwriting there, this is the key to accelerating the cash growth on a life insurance policy. Money I have in this piece, I can use and practice this sooner than later. Okay. Now, it is worth noting that dollars you pay into the PUA piece, PUA stands for paid up additional life insurance. It does buy us more death benefit. If I pay $1,000 in, it might get me another $3,000 in death benefit. Depends on my age, so that number is going to vary. Just a quick example there. So a question we get frequently, and this is what's going to determine if I have 60% of what I pay into a policy up front, or between 80 and 90% up front. Here's what it has to do with. We get this question all the time. Steve, how do I put 100% of my payment into the PUA component because I, Mr. Policyholder, don't care about the death benefit? We hear that, and I get it. The death benefit is important, but if someone's focused on the cash value component, we're going to educate them on that. So we cannot put 100% here. The reason why is we have limits. We have limits by the insurance company and also the IRS. Typically, some of the top companies, wherever you set that premium, will allow you to pay up to 10 times that into PUAs per year. Some have no limits. You can have your premium at 5% or 1%, not quite 1, but we can really drive it down. And then some have more conservative limits where we can only add another 3 times the minimum premium into PUAs. I don't want to get too deep in the weeds here. We do have content on that. Main point though, we have the insurance company limit. Typically, I can drive my premium down as low as 10%. So if I had a $1,000 premium, I can pay up to $10K per year with a lot of the companies over here. And the next piece we have is our MEC limit. Stands for Modified Endowment Contract. What many are not aware of is we can actually set that wherever we want. But what you will find is how we move that MEC limit up and down. When I say set wherever we want, it's when we first start a policy. The IRS really looks at one's age and death benefit to determine what your MEC limit will be. Think of it this way, the total amount of life insurance is the measuring stick that the IRS uses to determine if a life insurance policy is life insurance in their eyes or a pure taxable investment. So that's the policy design. And then we've got company selection. Now, I'm not saying these are the only companies to go with. These are the companies that in all of our studies have come out to produce the strongest cash values, and we have proof of it. We do not have proof from other carriers yet. We are working with many smaller companies to obtain that proof, but when you look at these companies, when you look at their size, their financials, they are massive and cream of the crop in terms of ratings. But my big selling point, what sells me on them, is when you look at cash value life insurance policies, we often see illustrations, but who's consistently delivered among the highest actual cash values. Remember, my point of emphasis, what I focus on is, okay, IBC, that's great. We want to teach you how to practice that, how to incorporate that. But again, if you maximize the cash value first, that puts you in a position where you've got more money to accelerate everything. That's the goal. These companies we've consistently seen among the highest cash values. Now, they don't all accommodate to the IBC strategy, so that's where more education comes in and such. But with that said, what we look at first and foremost with everyone is firstly, how do I design the policy for maximum cash value or the ability to maximize my cash value Quick side note, if I want the ability to pay in 10K, I can easily design a policy where I only commit to close to $1,000 per year and add the additional funds at my leisure. Same thing, if I want the ability to put in 100K per year, I can design it with a 10K minimum base premium and then have the ability to add up to 100 without being committed. So we can design a policy to be very flexible there, but what it does is, again, optimize my cash value. Life insurance at its core, safe, liquid, tax-free area to position money. Then I've got the company and the quality over here. Again, when I say quality, looking at actual data, who's delivered, we've seen it consistent with these guys. That's why I'm so big on the big four. Know this is a lot of info. Hope it helps. Reach out with any questions at all. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.